Good morning, everybody, and welcome to this week's weekly market analysis session. My name is Carl Capolingo. I'm the market analyst over here at Think Markets Australia. It is a pleasure to be with you as we wrap the key events from last week and look to the week ahead. Let's kick off with crypto markets. Just very quickly checking up on what's going over there. The Ethereum price is up 11.4%. We're just days away from the merge. That is that switch from the current proof of work, where you need a bunch of computers hacking away at that algorithm to validate the blocks, the information on that blockchain. It's what Bitcoin does, to the proof of stake mechanism, where you're not doing those complex calculations to validate. You've got, it's a consensus mechanism. You've got people, or whoever these people are, putting up Ethereum, and it's a consensus amongst the stakers there. Long story short, it, in theory, should dry up the supply of Ethereum because lots of people are staking, plus they're building in this burn mechanism, which will reduce the inflation of the blockchain as well. So, you know, if you can sort of dampen the supply side, if demand is growing because you've got this wonderful opportunity of all the DeFi on the blockchain there, potentially the price can do well. Anyway, it was the best performing crypto last week. Bitcoin up 7.5%, wasn't terrible either. Solana, which is a bit of a quote-unquote Ethereum clone, doing well also. The Fear and Greed Index is at 26, which is still pretty fearful, to be fair, but it is up from last week's reading of 20, which indicates extreme fear. Not a lot of news on the Bitcoin front at the moment. If there is, it's kind of merge related, Ethereum merge related, that is, because once all those mining rigs get discarded after the merge, well, what are those mining rigs going to do? Are they going to go over to Bitcoin and start to mine Bitcoin as well? And that could have its own implications beyond the scope of this chat. Bitcoin got a bounce. I think that's the key here. That's the big white candle there on, I think it was about Saturday or Friday night, Saturday morning. It all occurred, pushing it above the short-term downtrend zone. That's a positive to get above that zone, but it is still a very well-entrenched long-term downtrend, isn't it? So you can see my long-term downtrend ribbon here is, it's dark. It's a dark cloud hanging over prices. It's getting bigger as well. That's never a good sign. And it's coinciding with some pretty key static resistance points as well. So we say this is our dynamic resistance zone because it's moving. And these are our static resistance zones. And when they coalesce, you get a much stronger degree of resistance to upside movement. Hey, could we get there? Look, I think we can. I think in the short term, based upon the strength of this candle, we could take a look at that level, 25,366. I'm not going to get too excited because every time I do get excited about Bitcoin, when it has a nice candle like this, look over here, you know, nice white candles, it tends to just flitter out. So let's say my bias on this one is not as bearish as it was just last week, but it's hard to be a Bitcoin bull until we get above 25,366. I want to see it close above there rather than just sort of tickle it intra-session. The bear case is, we do flitter out. We come back to 18,535, and potentially, if we break 17,585, we'll go down to 13,800 is the next level of support, which is not on screen. If you're brave enough to trade Bitcoin, that is. If you're brave enough to trade Ethereum, I think it looks better than Bitcoin in that we've got more than just the one sort of white candle over the last couple of weeks, and we're kind of building into a short-term uptrend. You can actually see, if you squint there, the little light green zone has appeared on our short-term uptrend. So that's a good indicator, but we are still banging up against that long-term downtrend zone. It is flattening out compared to the Bitcoin one, so that's a little bit positive, but there is, again, this sort of confluence of some of these static levels as well. So slightly more positive on Ethereum. I'm happy to be a hodler if that's worth anything to you, but cautiously optimistic at best. I don't want to see it get below 1489. I certainly don't want to see it get below 1422. I think that changes your cautiously optimistic stance into sort of just coming back to the reality of that long-term downtrend. Hey, let's see how the merge goes. Having a look at equities, starting off with global equities, a reasonable performance there in Asia, just Hang Seng missing out, but it really was all driven by what happened here on the NASDAQ in the US, up 2.8%. That key risk on gauge of global equities. I don't really have any explanations for the bounce, as we're going to see as we get through the presentation. Really, if anything, maybe the data and the rhetoric from some of those central bankers was more bearish, which kind of makes it even more important, I think. When you rally on sort of bearish leads, it does kind of indicate there's a bit of money out there still looking to get into the system. Europe, their economic situation, they're far more dire than in the US. We had a 75 basis point interest rate increase at the same time as central bankers talking about potential recession. That's never a good thing. So that you can see why they lagged. Looking at the volatility index, it had a pretty decent bearish candle logged for last week. This is a weekly chart we're looking at here, and this is the fear gauge for markets. So quite a convincing move down in fear. Again, pretty supportive with, I think, what is starting to be quite a well-established downtrend now for that fear gauge. So facilitating potentially a bit more of a rally in shares. Having a look here at the S&P 500, the benchmark index in the US, it actually popped above its short-term downtrend zone, which is impressive. And more impressive is the candle it did it on, that sort of big white candle. 3 in a row there, the 3 white soldiers. You might have heard of those, usually pretty bullish pattern, but really only erasing probably about, just over half, maybe 2/3 of the decline we saw over the last 2 weeks. V-shaped rallies, they're always tough to trade, but so are the A-shaped reversals and the V-shaped rallies before that. It is a tough time for trend followers. So look, I'm going to back this longer-term downtrend here, but I think given the strength of this recent move, neutral is probably the best way to go. I know that sounds extremely boring, but sometimes just keeping that powder dry, not committing too much to the short side, not committing too much to the long side is the best way to go, and just going stock specific. So don't go and think, okay, the market's going to crash, I need to load up on shorts, and don't go, well, I think this is the bottom of the bear market and load up on longs. I think find the best bottom left, top right charts and be long those, and find the best top left and bottom right charts and be short those, and not have a huge exposure either way. Okay, you don't have to be fully invested at this point in time. I think that's the message from here. Resistance, what's in that band there? That's sort of a 41.50 give or take, where we could see the supply come in. Watch out for black candles in that zone. White candles is a-okay. We're probably going to go higher, but black candles in there will continue the downtrend. Break of 3,886 would be bearish into say 37.38 or 37.21. Having a look at the NASDAQ, just chatting key levels here. We're at one now, 12.140. That's the short-term dynamic resistance zone here from the short-term trend ribbon, and then at 12.656. What will change? What will change this to, unequivocally bull? Closing above 12.566 would be interesting, but I think a close above 13.181. I think we get up here and we're out of this bear market. Watching for black candles in here, that would be the key signal. A bunch of black candles around that 12.656, and we'll probably head back down again. Until then, I think we can probably get there. I think we can probably go have a look at that level. If we don't, if I'm wrong, a break of 11.471 would be bearish into that sort of 11 handle. So a window for further gains on stocks, but watching those key overhead resistance levels to potentially signal the re-establishment of those broader long-term downtrends. Okay, if I had to summarize. Let's have a look at base metals now. Nickel up 10%. Looks like a great week, but still down 5.7% for the month. Let's have a look at, say, Dr. Copper. Looks like a great week, up 4%, but still down 4% for the month. Iron ore looks like an amazing week, up 7.3% in Shanghai, in the yuan-based price, up nearly 9% in the Singapore contract, in the US dollar price, but you can still down for the month. Okay, so just reversing the previous week's weakness, and overall on the iron ore price, still, I think, very much in a downtrend. I think that's a message you need to watch out for here. Any recurrence of those black candles, I think, are just going to re-establish that downtrend. So I think still a fairly bearish reading for global economic growth. And that's what we're doing here by looking at these commodity charts. We're trying to get an indication for whether markets are feeling that global growth is getting better or that global growth is getting worse. Coking coal actually had a bad week, bucked the trend on a lot of those growth commodities which bounced last week. So again, this is that key component along with the iron ore to make the steel, which is the growth product, right? If you putting up another 45 apartment blocks in the middle of somewhere in China, you need the steel to do that. So interesting to see iron ore bounce, but coke and coal still coming down. That's the bounce on copper. But what I'm pointing out here is, yes, there's a bit of a bounce, but it's still long-term downtrend stuff. When these things all flip green, that's when the growth is going to be there. Okay, as long as we're still sort of dark pinks and pinks, I don't think you can get too excited on these markets signaling that the global growth is coming back. Having said that, look, the volatility is the word. Let's just see how this little rally plays out here. If we sort of find, say, another little peak coming in beneath 83.15, I think we're going to roll over again. We won't even get here. We'll roll over again. If we can break 83.15, we'll go up and test that higher level. And nickel, I think, is still very entrenched there in the downtrend despite its rally. Gold here, well, I don't know. What do you use gold for? It doesn't have a yield. Interest rates continue to go up, as we're going to see in a second. And gold, therefore, I do think it needs to suffer further, because it costs you to hold it. You can't really do a whole lot with it in the meantime if you're using it as a financial asset, and not to put something shiny around somebody's fingers or neck or on the wherever, So look, I think it will trend lower. 1680 is the key level here, 1676 from back in March also, and beneath that it's a very slippery slope into 1500. There's nothing in this chart that is telling me that gold is somehow going to miraculously turn around and go up. Just the candles, the price action, the trends are all far too bearish and compressing into that support zone. Having a look at the energy, currencies and bonds here, we can see energy down for the week, continuing the decline now, which has been progressing for over a month. This is another global growth indicator. You can see, like many of those global growth indicators, the trends are very much entrenched to the downside. What could change it for crude oil? I wouldn't get bullish on crude until it closed above 97.66. Otherwise, I think there is going to be some support around here. This sort of 70, let's call it 75 down to sort of 65. That is your balance point for crude over the long term. If you came up to me and said, hey, Carl, for the next 5 years, crude's going to average somewhere between $65 to $75 a barrel, I'd say, yep, that makes total sense. We're sort of working our way out of this sort of idea that supply is somehow constrained. It's not that constrained. Don't worry, the supply is there when it needs to be. The Saudis have plenty of oil and they can turn it on if that is their prerogative. It's just not their prerogative at the moment. So there was a very tokenistic small output cut of about $100,000 a barrel a day agreed during the week. And look, it didn't even rally prices. What does that tell you? It didn't even rally prices net for the week. Okay. Aussie dollar got a little bit of a bounce. I think just a little bit of a pullback there in the US dollar index, or the US dollar. I don't think anything much more than that. I can't see the Aussie dollar rocketing. Well, to be fair, it got a bit of a bounce on those commodities, but even then underperformed a bunch of its counterparts, didn't it? So don't read too much into that. Aussie bond yields were down and US bond yields were up. Let's have a look at some of the commodity contracts here for energy, starting off with natural gas. This is the NYMEX base. This is the US-based natural gas product. So looking at sort of the energy situation in America. Still, long-term uptrend, no doubt about that. Short-term uptrend is losing significant steam. And when you're going to get these sort of black candles, long black candles in here, I'm talking about sort of this one and this one, that don't see any pushback from the demand side. In fact, if anything, these upper shadows indicate that as the demand tried to push back to sort of re-establish the bullish case, they were beaten down by the supply. So not a lot of demand, and the supply is still very much in the system. We could see this one pull back probably a little bit further into 7. What's the importance of this? Well, obviously it helps on the cost of living side of things. It helps on the inflation side of things, because energy has been one of those key drivers of inflation. It makes the Fed's life easier. It makes companies' lives easier from transport costs, and it makes consumers' lives easier. So this is one of those key factors, I think, that's not getting a lot of headlines out there as for the reason for the rally in equities last week. So I think you need to keep an eye on this chart. I think it means a hell of a lot out there in that whole global macroeconomic picture. And if I'm saying probably going to come down into here, that also facilitates some of these scenarios we talked about before. You can have higher prices for equities, at least for this week. Hey, what does it do from here? Does it bounce off that and then ruin everything for equities? And then we hit the Northern Hemisphere winter. There are shortages, and we're printing above 10, and then the NASDAQ's down 2,000 points from there. Could be, I don't know. I just know we need to keep a very close eye on this one. Also, I think helping that risk-on vibe during the week was the fact that the European gas futures came off and continued to come off after their recent spike. But overall, I do think, geez, you don't want to go against this trend just yet, especially given where we are in, heading towards that Northern Hemisphere winter. There was some news out a week before last about how stockpiles have grown. So, countries trying to get ahead of that potential, crunch. Thermal coal futures, I think this is interesting. I mean, look, they came off at the end of the week, but still generally trending higher. So I think that is still supporting this energy shortage picture rather than that situation loosening at this time. So I think that it's still pretty positive for the likes of your Whitehavens, your Terracoms, and your New Hopes and your Yancoals out there that I know a lot of people listening are very much involved with those companies. Let's have a look at the bonds, or at least the yields. So bond yields coming down, which means bonds are rallying last week. Interesting to see local bonds being bought and stocks being bought, quite unusual. I don't think there's a whole lot in this picture here. We did get the Reserve Bank interest rate increase. It was very much as expected, and that therefore, there was a bit of a non-event over here in the yields. If anything, maybe there's a little bit of an edge down here on the fact that some of those rate increases are having a negative impact on the local economy. US 10s, I think this is a far more interesting chart, because we saw those energy prices coming down, didn't we? So typically you'd say that's facilitating lower inflation down the track. Lower inflation, you only need lower yields to combat that inflation. And yet bonds, US bonds sold off last week and the yields continued to rise. That's very interesting. What's going on with that? We'll talk about that in just a second. And just proving how much they were going up. So this blue line is where that US yield curve was last week. So you're at about 3.4 and a bit % for your 2 years. And then you're going out to, whatever it was. We just saw the chart there, just under 3.2% on the 10 years. So you've got this situation where the money is more expensive in the short term than the long term. And that's because investors are thinking, yes, short-term rates are going up. We got that. But in the long term, rates will have to come down because the economy is going to get broken. Okay. And that's why you get this inverted yield curve, because typically the yield curve is supposed to start bottom left and finish top right, because you should be compensated more for longer periods, for putting your money away for longer periods. We've got the inverse. Typically what that indicates is a weaker economy going ahead. Often inversions have been accompanied by recessions. In fact, not often, every time over the last 10 inversions over the last 50 years it's occurred, okay? So we are an inverted yield curve, but the curve is getting higher. What we saw last week is that the interest rates continue to shift up. Why did they shift up even though energy prices came down? Because of this guy here who, let's face it, started the bear market. Thank you, Mr. Powell. He said that he would continue to act forthrightly, the first time he's used that language, pretty strong language there, forthrightly, strongly, as they've been doing, to keep at it until the job is done. What can you get from that? The job isn't done yet. And on this possibility that rates could come down to sort of provide some relief once the job of fighting inflation has been accomplished, we hear from him that history cautions strongly against prematurely loosening policy. And that is why those rates went up. Amazing that the stock market rallied. I can only attribute that to that improving energy situation. US Fed Vice Chair Lael Brainard coming out and saying that households and businesses could start to expect inflation to remain above 2%. So we've got this sort of entrenched inflation. That is the worst case scenario for the Fed. That's what they really want to guard against. Again, another very hawkish statement from the Fed. So we should expect interest rates to continue on this path of tightness not neutralisation, not looseness for the foreseeable future. Helping a little bit, but skewed by obviously the lockdowns. We did see that the Chinese inflation data was weaker than expected and down previously, maybe making a peak on the CPI there, but certainly coming down sharply on the PPI. It does help the global inflation situation because China is largely an exporter of inflation or deflation, depending on what's going on in that economy, but it is again skewed heavily by those COVID restrictions and lockdowns. So, I don't think we take a whole lot out of that. What happened on the local economic data front? We saw the Reserve Bank increase for the, let me count that, 1, 2, 3, 4, 5th time in a row, up to 2.35%. That's a 50 basis point increase. Their forecast now for inflation is to peak around 7.75% over 2022. We're not that far from the end of 2022, and the current reading as of the last quarter was at 6.1%. So obviously September quarter is going to get up there, maybe December quarter as well. So still expecting inflation to be heading up, not to be neutralising at this stage. And they kind of hedged their bets a little bit. And that, I think, helped Aussie stocks, actually. I think it did help Aussie stocks, this idea of saying, well, we're on the fence. We can see that households are feeling the pinch of higher rates, higher inflation, cost of living, but at the same time, the labour market is very strong, and that's inflationary. Financial buffers are very strong, so we can keep spending, and that's inflationary. So it's kind of the first time in this 5-rate hike cycle that the Reserve Bank has moved more to the fence with their rhetoric, at least. Market is still expecting interest rate increases for the rest of 2022. We've got 2 more meetings in October and November, and we're still expecting to get about 3%. So if you do the math, 65 basis points, it could be, or how would that be? It could be another 50 and then a 15 or whatever combination that you can come up with to get to 3% by the end of the year. Having a look at Aussie stocks now, I'm just mindful of time, so I might pick up the pace. Sorry, everyone. But we did see a big bounce there. Material stocks, obviously, on the back of those metals prices moving up quite strongly. Gold got a little bit of a bounce there as well. Not sure why, just probably in line with the metals in the material sector rather than moving on that gold price, which we know was still heading down. Information technology, I think, actually looks half decent. I know it's the trends are still sort of skewed to the downside, but the momentum of the downside is definitely waning. It's more neutral now, if anything, and an interesting move last week. So keep an eye on tech.Maybe we can, there's opportunity for a bit of bottom fishing in there. So I think Altium looks good. One that came up on my list this morning, Dubber. I know it's a downtrend, but it's just starting to turn the corner. Looks good. WiseTech looks fantastic. Data3 looks interesting as well. I'm forgetting a bunch of them. But anyway, just run your ruler over that tech sector. Have a look at some of those charts. Otherwise, some of the defensives like your staples were underperformers there, utilities, another defensive sector. Looking at the technicals on the ASX 200, and we're up a little bit this morning. Let me scroll up. We're up about 1%. So we're in this pink zone here, which I do think is going to be a key zone. What do we print in here? Do we print a bunch of black candles indicating that the supply from this overall downtrend is starting to re-exert itself? Or do we print a bunch of white candles and say there's nothing to worry about? It's all demand here. So watch out for this zone, say between sort of 69.30 and sort of 69.80. If it's white candles, I think we'll go up, we'll test these higher retracements here, probably 70.50 could be the upside. If we do see the black candles, we'll roll over. We'll come back into 67.19. So I wish I could say, hey, this is exactly what you have to do, but I don't think that the technicals allow me to do that. I think you have to be respectful of some of these potential zones in here. Having a look at the technical analysis market breadth, so how many stocks are participating in the rally? And this is based upon Friday's close, of course, and we did see an improvement, which improvement was last week was kind of down here. So we are seeing the number of stocks participating moving back up to those August 11 highs, which was the peak of this last run, that from the bear market lows. But we're still well away from a bull market zone. So if we get back into the green zone, all is hunky-dory. We're going to go up and we're going to print new highs. Until then, I think the cautious approach I talked about earlier on in this session is the best way to go, because look at these sectors. I mean, as a trend follower, what do you do when you've got such a mix of short and long-term trends? And even in some of these downs, the trends are getting more neutral, if anything. So for discretion is a good example of that. If I had to tip one to look out for, would be the information technology. That neutral trend could flip back to up. Long-term trend is still down, but that's how, you know, long-term trends start, don't they? They've got to start somewhere. Materials improved last week. Healthcare was, I think actually that looks pretty interesting also. Have a look at healthcare. CSL looks pretty good in that one. If you one of the sort of bigger end of town. Pro Medicus looks pretty interesting. Clinuvel looks pretty interesting as well. CUV ticker code on that one. Apart from that, look, I'm not particularly enthused about any of those. Energy, some of the shine came out of that on those falling energy prices, but coal still looks very strong. Having a look where the value is in the Australian market, we typically say 15 is fair value for the Aussie market, 10 is where all those major bear market lows occurred, and 20 historically is where all those major bull market highs have occurred, including this last bull market that we were in. So we're on the better side of fair value. It is largely skewed by some very cheap energy and material stocks that are cycling those humps. So this is your value trap. If you go a few years out, this isn't 7, this is about 12. You know, in fact, both of them sort of, there's probably a little bit more, about 14, this is about 12. Okay, so I wouldn't say that as a whole, therefore, the market is exceedingly cheap even here, but probably not all that expensive. We talked a bit about information technology. Look, it's certainly well off its 77 highs. It's a little bit better even from last week, and prices and trends are starting to change. So, you know, definitely closer to the bottom of its range than the top of its range. If you could call it value, maybe there is some value there. Having a look at data coming up this week, Westpac Consumer Sentiment Survey, NAB Business Confidence. I think going to be important surveys this week to, obviously after those interest rate hikes have been in the system for a while now, to see how consumers and businesses are holding up. And then we will get our data, big data for the week there, the employment change and unemployment rate coming out on Thursday. Heading abroad, it is going to be about inflation. CPI data on Tuesday night for the US, and then their wholesale inflation data coming out on the Wednesday. Everything else pales in terms of importance after that. But markets certainly will look at retail sales. That is how the consumer is responding. Are they tightening their belts? We're forecasting 0% growth there, flat growth for that one. And then the University of Michigan Consumer Sentiment, very forward-looking indicator. Are people feeling more confident or less confident about the situation going forward? And we're actually expecting a little bit of an improvement there as well. Apart from that, catch me tomorrow for Ask the Experts at 1 p.m. Sydney time, where it's me versus your portfolio. So none of this macro stuff. We drill down to the nitty-gritty of the stocks in your portfolio. You ask me the question and I provide you with the analysis, technical and fundamental where possible. That's the link to register. Got a bunch of people coming down every Tuesday. We have lots of fun and we learn lots as we do it. So make sure you get involved. Why think markets? It's a bit of a no-brainer, really, with over 3,100 shares and ETFs at $8 flat rate trades, way better than any of those, your banks that you're probably trading with right now. You've been trading with them for years. Why keep paying those exorbitant fees? Come over to us. You'll save a bunch of money, and it is still CHESS sponsored. So I know there's a bunch of other brokers out there might be giving you a cheaper rate, but you get your trades pooled with everybody else. Here, they are absolutely your shares. You have the ownership of your shares, as you should do. If you want to trade CFDs, we talked about natural gas today. If you think maybe there's a shorting opportunity on natural gas as it pulls back, hey, if you think that it is going to pull back and then it's going to go ballistic, which is kind of the camp I'm in, okay, you might want to get yourself a CFD account ready and raring to go, because we do have a natural gas contract that you can trade. It's literally type in the quantity you want and hit the buy or the sell button. It is as easy as that. If you've got an opinion on gold, maybe you wanted to short gold, we talked about that today, or trade the Australian dollar, or trade crypto. Maybe you want to get long Ethereum. Is another possibility there. So hop on to the website there, thinkmarkets.com/AU. You could be trading any of those products in minutes, and of course, with all the support you need to make it happen. So if you're thinking, hey, what business do I have trading natural gas? Maybe I'll go buy Woodside instead. Well, I can assure you that if natural gas goes up, let's say 20%, it's pretty unlikely Woodside's going to go up 20% as well. Why? Because Woodside does a bunch of other stuff, okay? So if you've got a view on a commodity, I feel it's best to just go trade that commodity, and that way you know if it goes up, you get it right. Now, award-winning broker, that's us. Easy-to-use multi-asset platform we talked about. You can have your self-managed super fund over here doing your self-managed super fund stuff. You've got your banks, your BHP, and then you can be trading your natural gas over here with your CFDs. World-class trading apps. We've just launched a new one called Think Trader, and all the support you could possibly need to make it happen. If you're watching me on YouTube, hit the subscribe button to stay notified of all of my future video updates, and make sure you hit the like button to let me know you like what I'm doing so I continue to do more of it. Apart from that, it has been an absolute pleasure chatting with you this morning. All the best for your investing until we catch up again. Bye-bye for now.